Welcome to Life Plan Differently with Rick Dwyer from Argallus Financial Group. In this podcast, we'll help you connect your personal expectations to your financial realities. Join us for this journey where we take a holistic approach to financial planning as Rick Dwyer draws from years of experience and guest experts to teach you how to avoid costly mistakes in your financial planning.
This is the Life Plan Differently podcast with Rick Dwyer of Argallus Financial Group, and welcome back. Managing assets, it's a big part of being a financial advisor, but not every advisor does it the same way. I'm Patrice Sikora, and in this episode, Rick talks about the managed money process he uses. But first of all, Rick, what is AUM, or Assets Under Management? I see that a lot.
Yeah, so assets under management refers to the accounts that you have that are in the market. And for what we do for our clients is we'll help them to manage their IRA accounts, their Roth accounts, their taxable accounts. So those type of accounts where you have either ETFs or individual stocks and bonds or mutual funds.
You manage all types of accounts then, right?
We do, and we actually can also assist people who have 401ks or other accounts at their employer. We cannot help them to trade those accounts, but we do work with a number of people who are years away, or in some cases actually decades away from being ready to retire, but they still want to have help on how to manage their individual retirement accounts at work, or I should say their 401ks or 403bs or TSPs, and we can help them with that as well.
Now, do you help them decide how much risk they can tolerate, or do they really want to be in safe investments? How do you do that?
So everybody's risk tolerance is different, and we do give each of our clients a risk tolerance questionnaire, and ours is actually done slightly different. Most people are asked a series of about 10 to 20 questions, and based on their answers, they get some sort of rating as to whether they're conservative or moderate or aggressive or some flavor in between. Well, we don't really do it that way. We have a slider on our site, and then all our clients do is they move that slider over, and what it's doing is it's taking the amount of money that they currently have in the market, and it's going to show them the potential return and then also the potential losses based on the level of risk that they've selected as they move that slider across. And they just keep moving it until they've reached the point where they're no longer comfortable with the amount of risk that they're taking. And then that's kind of the baseline that we use to start developing a portfolio strategy for them.
And everyone does this? Every client?
Every one of our clients.
All right. Okay. How have they performed recently with knowing what they want, what they don't want? How have your assets performed?
So that's a really interesting conundrum because they've actually performed exceedingly well this year. We have a couple different portfolios. And as you may recall, in March, due to COVID, the economy was shut down. The market went into a free fall. In fact, it was the fastest decline, down 30% in U.S. history. We actually topped out being down on the S&P right around 33 to 34%. And as you know, the market's been coming back since, but that big drawdown had a major influence on returns for the S&P 500 this year. How have our portfolios performed? That was your question. So depending upon which portfolio you're in, our flagship portfolio is currently up 85% for 2020.
85%?
85% for 2020. Now, the reason I said it's a conundrum is because when you tell someone it's up 85%, first of all, not many people are going to believe you.
No.
That's problem number one. Problem number two is, what do you do for an encore? But here's the reality. We were up 42% for 2019. And for this year, we're up 85% so far for 2020. And we actually did it with less risk than the S&P 500. And you may say, well, how is that even possible? Well, if you were to buy a mutual fund that represented the Standard & Poor's 500, the S&P 500, you're literally buying a piece of every single stock that's in the S&P 500. Well, some of them are doing really, really good. And some of them are doing really, really bad. And then you have some in the middle doing some okay, some not so okay, and some maybe a little bit better than okay. But the point being is you're buying the good, the bad, and the ugly of the S&P 500 when you buy that fund or that ETF. An ETF, for those who don't know, is an exchange traded fund. It operates and trades kind of like a stock, but it's more affiliated or associated as a mutual fund.
Mm-hmm.
So you're buying a basket of stocks when you buy an ETF. So when you buy that index, you're buying everything in there. We don't do that. We buy individual stocks. Some of our holdings have been held for years. Some of them get held for months, and some get held for a relatively short period of time, maybe just a couple months. It all depends upon how they're doing. But we stay out of sectors that we know are doing bad. For example, we've been out of energy for a long time. And when the tariffs, when that language was out in the public domain and everybody was talking about the damage being done by tariffs, our positions weren't being affected by tariffs because we weren't in positions that were being impacted by the tariff negotiations going on between China and the United States. So we tend to try and avoid things that are a potential conflict, and we try and stay invested as long as possible in sectors that are doing very, very well. And some of our best performing positions of late have been Zoom, as an example, as you know, because of COVID. A lot of people are now forced to work from home. And guess what? Zoom was the big recipient of that. And we've been a long-term holder of Zoom. So that's been one of our top performers.
Wow, okay. And just out of curiosity, before we go on, because I want you to give me some more examples, where is the S&P now? How much has it gained back? I know it's positive for the year.
It is. It is currently, as of yesterday, up 6.6%.
And that's pretty incredible when you think about it. Down 30%, now up 6%. And your performance has topped that.
So the S&P for the year is up 6.6%, which for the S&P is right in line with a fairly typical year, being somewhere in the 7 to 8% range. So, there's still a few months to go, and it may still pull out that 7 to 8 or possibly even better return. And that's after a 30% or 35% plunge. So the S&P is actually done rather well also. It's just that compared to the S&P, we're up over 12 times as much.
Oh, give me some more examples.
Well, so, what's interesting is people will then say, oh, well, you were in at perfect timing. And so, we missed all of that because we didn't get in last year. So I'm going to give you an example of someone who came in, let's just say June of this year.
Okay.
So June was after the market started really snapping back and rebounding. So we have a client that came in on June 24th. So let's see, July, August, September, not even 4 months, and they're up over 31% currently as of today.
This is the time.
That's an example.
Well, and this is the time the market has been coming back too. So they were riding that crest.
Yeah. So we have another client that came in late August, and they are currently up. So it's not even been 2 months. You had September, and now we're in October. So it isn't even a full 2 months yet, and they're up 19%. And
again, you are not in what you would call mutual funds or ETFs. You're doing individual stocks?
Yep. These are all individual holdings.
All right.
And we limit our holdings are usually on average around 20, but it can range from around 15 to somewhere in the mid 20s. That's kind of the average amount of holdings. We don't go over too many holdings because there's a whole theory. I want to spend a lot of time and bore the listeners, but when you have too many holdings, that whole theory of diversification gets watered down. And as you add more and more positions, you're not really improving the benefit of diversification. You're just really watering down your returns.
So how diversified are you?
So as I said, we have anywhere from around 15 to 25 to 28 holdings. I think currently we're at around 25.
Okay. Can you show someone how their funds would have performed?
Absolutely. We have some of the funds or portfolios, I'm not going to call them funds. We can show someone how their funds would have performed during any period of time. So let's say they started a year ago or they started 10 or 15 years ago. We can show them how those funds would have performed during that period of time, or any other time. They just have to let us know which period they want. We'll plug the numbers in and we can give them a report right then and there.
That's probably really depressing if it's better than they were getting.
Well, I mean, the reality is a lot of people here, you can't really outperform the market. And while it's not an easy task to do, I think if you stay focused on sectors that are currently doing very well and out of sectors that look like they're not going to do well, you are probably going to outperform the market over time. However, you will have those odd moments where you may have missed the boat either on the upside or the downside. And so you can overswing in either direction. You can have some larger than normal losses at certain times, while you're also having larger than normal gains. But I think in all, what we've been able to show our clients is that we've been able to not only show them superior performance, but we've also been able to do it by showing them that we've been able to mitigate the risk. And as an example, on one of our portfolios that's up around 29% for the year, so it's not up nearly as much as the other one. But when the market was down 35%, it was down less than 17%. It was like 16.6 for the March period. So depending upon how comfortable someone is with risk, we have different portfolios that we can use. And at the end of the day, it's finding out what makes sense for the client.
Tell me about the clients. When they see such fantastic gains, how do you manage their expectations?
So that was part of the conundrum I mentioned earlier. It's like, so last year we were up 42%, this year 85% for this year. So, we just say, look, we just have a strategy that we stick to, and no one knows how that's going to work out until the year is over. Now, the year before, in 2018, the market, the S&P was actually down around 6%, and we were down around 5%. So although that is an outperformance of the S&P, we were still down for the year. So it's not like we're never going to have a down year, or during the year, it's not like we're not going to have drawdowns when the market goes south, as it did in March of this year. But in 2017, the market was up around, I think it was 18 or 19%, and we were up a little over 20%. So that's also to show that just because we have this strategy, it doesn't make it's not a silver bullet. There are going to be years where we can have losses, and there are going to be years where we may not outperform the S&P, or if we do, we may not outperform it by much. But when all the stars align right and everything is looking with the winds are in our sails at our backs and everything's going really good, then we have years like this year.
Is there a minimum investment that you ask of clients?
Yeah, so unlike a lot of firms, we do have a minimum, but it's very low compared to a lot of managed money accounts. So for the one portfolio, which is up currently at about 85%, the minimum is 100,000. And for our other portfolios, for the example, the one that's up just under 30% right now, the minimum for that one is, I think it's 10,000 for that one.
Okay. Does it take a lot of work to keep your eye on these portfolios?
Well, I wish I could take credit for doing all of the trading, but I don't. So our firm does it internally in our trading department, and we also use a third-party asset manager to trade one of our portfolios. So they have a complete team that's there watching them all the time.
Right. All right. How can an investor get started with you guys? Because it sounds like I wouldn't be surprised if there are people out there saying, "Hello, Rick, I want to talk."
Yeah, I just want to talk about one of the other conundrums when you said, how do you explain this to your clients? I will tell you that the part of the conundrum is when you're showing people the returns that you're generating who aren't clients yet, and they see those returns, they're like, well, that's impossible. There's no way that's true. And I've actually had people walk out the door because they just didn't think the returns were real. So that's kind of the Bernie Madoff in the back of your mind, that this is way too good to be true. And, I'm just not going to fall for it. So the one thing I do want people to know is our accounts are custodied at Charles Schwab or TD Ameritrade now, that since they've merged, but they still operate as two separate entities. So we don't custody the money. We don't make up your statements. They're made up by the custodian. They're mailed out. You have online access to your accounts. You can see the value on any given day. So I just wanted to clarify that, because people have to, they seem to think that maybe we're cooking the books. Well, we're not even holding the books. The custodians are doing that. And so I just wanted to clear up that one last point. So in answer to your other question of how can someone get started? Well, first of all, we would recommend, let's take a look at your existing portfolio and let's compare it on a given time scale that you're comfortable with, and see how our portfolios performed versus how yours performed. And let's see if there's any way for us to work together. Sometimes there just aren't, because our philosophies aren't aligned. But if they are, and you like what you see, then it's very easy to move those accounts and get them under our management umbrella, and hopefully start bringing you the same returns we're currently getting for our clients.
And how can they reach you, Rick?
Well, once again, they can go to our website, which is argallus.com. That's ARGALLUS.com. Or, and by the way, we do post our performance reports on argallus.com. And the second way is they could just call us. And our number is 904-800-7299.
All right, Rick Dwyer of Argallus Financial Group, talking about his managed money process. To know when new episodes of Rick's Life Plan Differently podcast are posted, use the subscribe button on this page. And to share, use the share button. I'm Patrice Sikora, and let's talk again later.
Thank you for listening to the Life Plan Differently podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Argallus Financial Group, Inc. or Capital Management Services, Inc. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your investment planning.
Investment advisory services are offered through Capital Management Services, Inc. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining values. None of the information contained during this podcast shall constitute an offer to sell or solicit any offer to buy a security or any insurance product.